We've crossed the ditch, just temporarily, to film some episodes with analysts, economists, acquirers and entrepreneurs, covering technology. I have an unhealthy obsession with data centres, and all things finance and investing. UBS has let us inside their Sydney trading floor. But first, I wanted to find out how Australia's economy is coping after enduring what could be one of its slowest periods of growth in 3 decades. So I reached out to the team at JP Morgan to explain it all, from jobs to house prices and even company profits. Let's get into it.
We actually haven't seen this degree of volatility in a season ever. But there is no question that companies pretty much across the board are saying, hey, there's still pressures out there. We're feeling wage pressures, we're feeling material cost pressures, we're concerned about the impact on supply chains of tariffs.
We think this year Australia's probably about a 2% growth type economy.
Still not much, is it?
It's still not much, but it's kind of in that sweet spot, we think.
Australia's economy has been struggling for all the same reasons as many other Western countries. High inflation and wage growth, fueled by stimulus measures and then fanned by higher interest rates, hurting its housing market and ultimately the population's ability to afford living. To keep things tight, the Reserve Bank of Australia kept rates on hold for the entirety of 2024. But they've kicked off this year with a 0.25% rate cut, easing an almost 5-year period of restrictive economic settings.
Inflation has fallen, and recent data suggests it's eased a bit more than expected. Growth in private demand has also been quite weak, and wage pressures have eased.
That seems to have put a spring in Australia's step. We're filming this at 5 p.m. on a Monday evening in Sydney CBD, and people are out shopping after work. But when I spoke with Aussies earlier today, some were still cautious.
For business, it's stable, but for individuals, things are getting more expensive.
You're not dressed like you work in finance.
I'm from Melbourne, so long weekend in Melbourne. So
Unreal.
Just catching up with friends, so yeah.
Cool. So you work in Melbourne in finance?
Yeah, lending.
Okay. Housing?
Nah, more business, more
Alright.
lending to small to medium type businesses.
How's that going? Rough?
Yeah, hospitality and retail, it's pretty rough at the moment.
Don't get me wrong, if you want to buy a house here, you can. You just look at a mortgage for the next 30, 50 years. In summary, yes. Or you find a sugar daddy.
I heard OnlyFans pays well.
We were just talking about that too.
I do. Like, I think for me, it's like the small purchases. It's kind of how I get through it all. I guess for me, like, I don't own any house or anything. Like, it's a very far away achievement for me. So in the meantime, I have to just kind of enjoy the small things to kind of make it work.
Do you feel like that would ever be possible for you in a place like Sydney?
I don't think so. I have actually looked into it, but
Cool.
because it's just me, like, I don't have any help, I don't have a partner or anything. So
You need that sugar daddy you were talking about.
I think so.
Ben Chicken. How's the economy going, Ben Chicken? To get the more official word on the state of the Australian economy, I spent the day inside JP Morgan and started by talking to their chief economist, Ben Jarman, who was named one of the most accurate forecasters of 2024 by the AFR. He thinks there's 4 more rate cuts still to come. Well, nice to meet you. Thanks so much for doing this. I really appreciate it.
Thank you, thanks for having me.
It seems like Australia is in the beginnings of a bounce back. Tell me if I'm correct or wrong on that.
That's fair.
What are the numbers suggesting to you about where the Australian economy is right now and also where it's heading?
Yeah, so we think the economy troughed out at about a 1% growth rate. Certainly that's a better outcome than we've seen elsewhere. We've had a lot of economies which have had larger increases in unemployment than we've seen in Australia, which maybe had a technical recession or a double dip recession. So the fact that we're troughing out at those relatively benign levels is a good outcome. We've seen since late last year the consumer pick up and really you can start the retail sales recovery. The clock on that really started late 23. So you have a bit of a pickup that's coming through, lower inflation. We had some tax cuts second half of last year. And just the absence of rate hikes for a while helps too. So if you've got that combination, that's starting to feed through to GDP growth as well. We think this year Australia's probably about a 2% growth type economy.
Still not much, is it?
It's still not much, but it's kind of in that sweet spot, we think, where you're doing better than we had, but you're not doing so much that you're putting pressure on capacity again. And that's kind of where you need to be if you're still managing these residual challenges on inflation. You want a sort of not too hot, not too cold type recovery, and that's kind of feels like the balancing act at the moment.
Goldilocks recovery.
Goldilocks, I didn't want to say it.
Isn't that what you guys call it?
I'll jinx it if I say it, but it does feel like a soft landing at this point in that you've managed to get inflation down, but without too much damage in labour markets in particular or in growth.
And all of that happened before the RBA even cut rates, although it was more of a shave than a cut, wasn't it?
Right.
Why are they being so cautious?
I think they're just really keen to draw the distinction between what might come from here versus where we entered the pandemic. So we obviously entered the pandemic with incredibly low interest rates. They were held even lower for a long time. And I think they're worried about this psychology that in the past, once you've gotten one cut, you've gotten a string of them. And what they don't want is for households to sort of really open the shoulders and swing hard into that dynamic and say, okay, well, we're going to get 100 or 200 basis points of cuts. So you have this sort of mixed message where they take a small step, but they don't want people to, for example, in the housing market, just really lean into this in a big way. So that's, I think, why they're caring more about the message that comes alongside the cut. What they end up doing, I think, will still be probably more easing, and we have 100 basis points total of easing in our forecast for the next 12 months or so. But I think they're reluctant to signal that up front.
That's interesting, because if they outright said they were going to cut further, like, for example, the Reserve Bank of New Zealand did pre-Christmas and then came out with a 50 in Feb, the market priced that in, and then the RBA would have no leverage, right?
Yeah, I think that's true. So there's an element of how much certainty do you have? And I think in New Zealand, they kind of had the sense that, look, we need to ease policy. And they also need for that to operate through fixed mortgage rates. In Australia, you have less benefit from being very explicit because it's mostly variable rate mortgage system. So until you're ready to deliver it, it's not going to flow through to mortgages anyway if you say something. Why sort of overcommit, if you like? And we've also been through this episode in the pandemic where the RBA was really pilloried for, no rate hikes till 2024, ended up having to hike in 2022. So they're also wary of the perception of promising too much and then under-delivering, so that's part of it as well.
Aren't we all? The job market confuses me in this economy. It sounds like it's been a tough economy, yet Australia added 44,000 jobs in the month of January alone. Like, how does that play?
Yeah, well, we think there's a couple of things going on here. One is productivity has been weaker since the pandemic, so you can have this kind of mismatch where growth is soft, but we still have, effectively more hours being worked in the economy for a given level of output. The other factor, which is more recent still, is we're just getting more and more strength in the supply side of the labour market. So we're getting population growth still surprising to the upside, participation still surprising to the upside, and a little bit at the margins, wage growth is coming down. So it's becoming just a little bit easier for employers to justify hiring people, even if their output growth isn't that strong, because it's just becoming a little bit cheaper at the margin to do that.
Australia's economy relies on iron ore exports to China, and that nation is currently caught up in a trade war with the United States. What about tariffs, Ben? How does that play for Australian companies, the Australian economy? How much of an impact could it have?
Right, well, I think it's hard to keep up, obviously, but the impact for Australia and New Zealand, we think it is relatively narrow in the sense that we're not economies down in this part of the world which have large running surpluses versus the US. The areas which do seem to be some concern is in specific areas that have some sort of strategic importance for the US, like aluminium and steel. Even on those, for the whole economy, like for Australia, for example, we're only talking about 0.1% of exports is going to those sectors to the US. But in individual parts of the economy where there's a lot of sensitivity, we worry a bit more about New Zealand because you're starting from a position of current account deficit that's deeper and an economy overall which is just a bit more trade exposed. So that's where we're a little bit more concerned.
Amid all of that, JP Morgan's team is watching stock markets and allocating client funds accordingly. They are, after all, an investment firm. I wanted to know exactly what they're buying and selling and why. And who better to ask than Jason Steed, the head of Australian equities, who just wrapped up a chaotic company reporting season. Well, Jason, it's lovely to meet you. Thank you so much for doing this. Appreciate it.
Good to see you, Madison.
Let's start with Aussie reporting season.
Yeah.
It's, I'm sure, fresh in your mind. Looked really volatile. Describe the volatility in share price reaction, what you think was driving it, and how it compares with other really high vol periods we've seen in recent years.
In a word, extraordinary. We actually haven't seen this degree of volatility in a season ever. Certainly not in the last 20 years. It didn't happen in COVID, it didn't happen in the GFC. And the way in which we think about volatility is the degree to which stocks are moving in terms of standard deviation. So what we saw was extremes at both ends. So nearly a third of the Aussie index that reported during February moved by 3 standard deviations or more, which is a huge move in the context of what was, in some cases, which I'm sure we'll get to, information that, as we saw it, didn't justify the degree to which the stocks moved. So the market came in with a mindset of any new bit of information, if it shifts that trajectory, is going to be traded hard. And that's what we saw. It was concentrated in a few sectors, but I think to answer your question, results season is always intense, always volatile, but I think we can say, certainly with a degree of certainty, that this is the most volatile this century.
That's wild though. Talk to me about the investor expectations out there and why they're like that, given that this state we're in now is not a pandemic nor a financial crisis. It seems, at least on paper, far better than that.
I think there's no doubt. And when I think about my team's projections for the season, what they anticipated was that there'd be a lot of companies that generated and delivered inline results. In fact, it was a very high proportion. They predicted around 55%.
Wow, the majority.
Unusually high. Normally it's around 35 to 40, and they were spot on, my team. So that shows you that we've passed COVID. We're seeing sort of margins stabilize. We're seeing, to a certain extent, conditions stabilize. But what happened on, I guess you'd describe as the tails, where in certain instances companies perhaps that had traded really, really well, there hadn't been new information, kept on going higher, multiples kept on expanding, there wasn't much earnings upgrade momentum, suddenly came up against a new piece of information that changed the narrative. That was the trigger. And in any situation where you have high multiple stocks, as you know, where there is a shift in the narrative and investors stand back and say, hang on, we're looking at a different trajectory here, that's what can bring about these really sharp moves and these 4, 5, 6 standard deviation drops, or in some cases, moves higher in share price.
So it seems like investors are hungry for a story, an earnings upgrade story, and if a company doesn't have it, it's see you later to the stock.
I think definitely. What we've certainly seen in Australia, and I think it's a global phenomenon over the past 5, 6, 7 years, is an increasing focus on short-term earnings. I think we're always talking about short-termism, how's it affecting the mindset of investors, how does the market react? But there's no doubt in Australia, the focus from investors on what the short-term trend in earnings is having a bigger impact on stock performance. So if you have a situation like we saw many times in results season where there was a sudden shift in expectations, particularly if it went from meaningful growth to maybe even just moderate growth, that was enough to really shift the share price. And what happens too, because it's been a tough year for investors, especially as the banks have outperformed, I can say that in the context of our own model portfolio, which has been underweight the banks, there was also a reluctance to step in. When stocks are falling as sharply as they were, I think investors stood on the sidelines and said, actually, I'll wait to see what happens before I step in. Even if I do like that company, think the long-term prospects are positive, I'm going to stand by and wait and see what the wash-up is. So what we didn't see in the season, which we have consistently over most seasons in the last few years, often you'd see this big sell-off on day one, and then the stock would revert because you'd see people stepping in to buy, and vice versa. Stocks would rally, and then they'd come back a bit. This time around, stocks have dropped and stayed down. Stocks have gone up and stayed high. So it does reflect to a certain extent investor sort of apprehension in terms of performance and a bit of risk aversion, which is exacerbating the degree of these moves and the persistence of these moves.
I do want to ask you more about pricing and perhaps if a C-word correction is on the way, but just specifically on that behaviour trend from investors. On your point about short-termism, is that trend itself short-term, and do you think that will eventually recalibrate in terms of investor behaviour, or is this something that companies now need to get used to?
I think they have to get used to it. I think there's no doubt there are so many more strategies at play in every equity market around the world now, whether it's EPS momentum strategies, price, factor, market neutral, pods are very active in this market, hedge fund pods. as well as obviously the rise of passive and ETFs and the influence that super funds have, let alone long-only active. So there are a lot of factors pushing and pulling at prices, and some of those find their way into that short-term bucket, which when you look at, say, for instance, turnover versus market cap, which has dropped a lot over the last couple of decades, as you've seen a greater penetration of passive and ETF, what that's doing is when you see these change events, these injections of new information, that's what triggers these moves, and it might be about earnings. And ultimately, earnings are the ultimate barometer over the long term, so one would hope the short term is indicative of the longer term. But I would certainly say that companies and investors are and need to be more sensitive to those short-term movements to get a grip on what's happening, as we saw in this result season where volatility is really, really high.
Broadly, not just in Australia but global equity markets, what do you make of pricing? Is everything priced too high still and due to come down?
Well, Madison, we came into this year, which is the first year as an equity strategist, I've come in with downside to my index target. So we set out our stall in January saying, look, we do think that the ASX 200 is stretched. So we set a target of 7,900. It's come back towards that level now. So in that context, I'd say Australia at an index level looks fairly valued. There are corners of the market, no doubt, that are looking stretched. I think elements of, say, the banks still do look as though the fundamentals don't quite justify very high multiples to book against quite low dividend yields. But I do think with this, I guess, setback or pullback that we've had in the first couple of months of 2025, I do feel that we've seen a more rational pricing environment return. In the US, we're tactically sort of, I guess, cautious in the short term, but in the medium term, our strategists there do still see meaningful upside. And the key factor behind that, back to earnings, is that we see a much stronger earnings trajectory in the US than, say, we do certainly in Australia and most other parts of the world.
If we can go specifically into sectors, and you mentioned banks in that answer, you are, from your model portfolio that I looked at, significantly underweight banks. Talk to me about that position. What's your thesis for it, and how far through it do you think you are?
So we heavily lean on our fundamental team of analysts. So I've got a fantastic team here of analysts that work night and day to produce thoughtful, insightful research. And what the view from a banks team has been that we have some very strong banks in Australia that are in areas of their business, in some cases, certainly market leaders or region leaders.
In New Zealand they are.
In New Zealand they are indeed. What we've seen here is pricing just move away from the fundamentals. I don't think we'd argue really for any of the Australian banks that there are fundamental, deep-seated issues within the operating model, within their market positions, but we would say that for various reasons, price extended well beyond the fundamentals. And that's where our view emanates from. It's not to say we see a burning platform that's about to break down. We just say it's the fact here that it's hard to justify these multiples in the context of the return on equity that these companies are generating.
Let's talk about the opportunity out there. What do you overweight?
So we do like the REITs. REITs is a sector where we see with bond yields set to stay where they are or potentially decline even further. There's an opportunity in our mind there. And within that sector, the retail component of the sector, tax cuts here are starting to find their way out of bank accounts into tills of the retail operators. So that certainly benefits some of the retail REITs in our market. And we are beginning to see a turn in the office cycle. It's early stage because office has been a difficult asset class within REITs. But as we're seeing occupancy rise, as we're seeing more and more people return to the office, that's driving up, we'd say, or it's bringing to an end, more specifically, the devaluation cycle. And we're probably going to see over time an improvement in the valuation picture for the office REITs. But many of them still are trading with deep devaluation priced in to their NTAs. So those two sectors for us stand out around the REITs. Industrial also looks quite good. And we're seeing certain segments of REITs move into data centres. So there's a lot to go for within the REITs.
Funny you mentioned that. I'm going to film CDC data centres with the founder, Greg Borer, tomorrow.
Well,
so I'll have to ask you after this for some questions.
Yes, I'm sure that'll be an interesting round.
You mentioned there's some economic stimulus coming into the economy, but obviously companies are still in a bit more of a survival mode at the moment until that stimulus is felt through their profitability. How does profitability look across sectors at the moment? Are there some that are more margin squeezed than others? And for those that are squeezed, how are they handling it? Are they putting in cost-cutting measures, CapEx changes?
It's interesting. This season has marked, I'd say, whether it's a new normal or return to normal, we've seen a degree of margin stability across the index. And that has suggested to us we've cycled out of COVID with the margin expansion we had in COVID and then the margin drawdown. So we've come out of that into a more stable period. But there is no question that companies pretty much across the board are saying, hey, there's still pressures out there. We're feeling wage pressures. We're feeling material cost pressures. We're concerned about the impact on supply chains of tariffs. So companies are still anxious, I'd say, about the outlook. And a lot of them are dealing with that by announcing extensions to cost-cutting programs, new cost-cutting programs. So it feels to us, and we framed this in some research we did recently, that cost-cutting now is almost a BAU type construct. The majority of companies out there have some form of cost efficiency plan in place. And that is, it's a defensive posture. But as we look forward, we've got tax cuts, as I mentioned, which are coming out of bank accounts. Consumers were quite defensive at the back end of last year. There hadn't been rate cuts. They were concerned about what was happening in housing because house prices were actually starting to, bottom out and then drop. Actually, not bottom out, they were dropping and then moved into negative territory. We hadn't seen any rate cuts from the RBA, so no one was spending. Those tax cuts, we've seen that shift. Obviously, the RBA has cut once. The employment backdrop is positive. So I think that's helping households to release. So that alongside tax cuts and potential fiscal stimulus around the election, that's probably a bit more positive on that front now.
One thing that I saw in your research as well, which I found very interesting, and the reason I say that is because we've seen this in certain sectors in New Zealand as well, the point of bifurcation, where in some sectors, you pointed out insurers and banks, there are standouts and then underperformers despite them being in the same industry. Where are you seeing that, and explain why you think it might be happening?
There are a few sectors. We've seen it in supermarkets between Coles and Woolworths.
So Coles is doing well and Woolies is not?
Exactly right. But
they sell the same stuff. Like, how is that?
They do sell the same stuff. I think you're seeing probably Woolies struggle a bit more around the management change and around some of the pressure that they've been under in terms of they've had some strikes, they've had some stock issues. There's a question mark around their pricing and how much of, say, cost cutting they might reinvest into pricing. So you could argue perhaps at this point that Coles has got the jump on them in terms of pricing, and that's been a factor in the differential between the two. You can see it in insurance, where you might have a situation where IAG has, I don't think it's a particularly large question mark, but a question mark over GWP growth, and then QB looks like they don't have quite the same degree of top line pressure. You see a big gap between the two. Now, what we're looking for is companies where that gap opens up, but we think it's not justified by the long-term story. And that's where our analysts step in and say, we don't agree with this big sell down or the bifurcation that's opened up between two stocks in a sector. And we come back to those stocks as the real opportunities.
So it seems like that old adage of when the tide goes out, you see who's swimming naked in terms of management.
I think that's right. And there's no doubt there's always pressure on management, but I think in this environment, particularly in certain sectors, supermarkets being one, where you've got an election that's imminent, the politicians at the moment have their sights trained on the supermarkets, given the cost of living pressures that a lot of society is under. You've also got at the same time the fact that there's an ACCC investigation with a report due relatively soon. So there are parts of the market that are under quite a lot of scrutiny and pressure, and that's where companies are coming out and say, well, we need to be defensive, cost cutting, we need to think about how we price, etc.
Speaking of scrutiny, and I want to end our conversation talking about valuations again, because I think investors are always interested in this. On the ASX, utilities had a great val start to the year, I think it's fair to say. Technology, IT did not.
Yeah.
Do you think that that is the beginning of a trend, or is that the case of a few isolated incidents, namely WiseTech Global?
I'm going to give you the sort of on the one hand, but on the other, I think it's a combination. I think the sell down in WiseTech has had a big effect on the performance of our tech sector. It's a very large component of the sector in terms of index weight. But if you look more broadly globally, tech has been struggling for various reasons. The what does DeepSeek do to NVIDIA? What does the recent Alibaba announce? So there are a lot of cross currents that are putting pressure on the tech complex in general. And so you're seeing that shift emerge. And you could argue that tech was sitting within that momentum basket, which had done tremendously well, and momentum has turned. So there's certainly parts of the tech sector that look attractive to us on a global and local basis. So I would say there are certain company instances that have had the effect of pulling down tech as a sector, whether it be within the companies or the broader macro effects. And then there's the investor allocation question, which is, do I want to scale back my exposure, which I think goes to the heart of your question, to tech and pick it up in other segments of the market, which maybe have lagged a bit over the past 12, 24 months.
To sum up this chat, correct me if I'm wrong, but it feels fair to say that investors in Australia are looking for, or rather more sensitive to triggers to sell rather than triggers to buy.
I think on balance, yes. There's no question that they are looking. I mean, if you're a long-only investor, you're always looking for those ideas, but at the same time, you're always fearful of the stock in your portfolio that might cause you a lot of pain because something happens which takes it down 10, 15, 20%. So I'd say yes, there's always that risk management that's trying to identify where you don't want to be. But equally, you're saying, what might I have missed, or what might the market have missed, particularly after results season, that's going to take this stock 10, 15, 20% higher over the next 12 months.
And it is your job to find them.
That's right.
I'll let you get back to it. Thank you so much for your time, Jason.
Thanks,
Great to
Madison.
chat.
Good to chat.
Jamie Dimon, you're up next. Thanks for watching Markets with Madison. If you enjoyed this interview, please hit the like and subscribe buttons below. I do all of the research for these episodes myself, so your support means a lot. I always love to hear your feedback and ideas, so please drop any thoughts in the comments below. Now go put your money to work.